Let's get into Xerox is our next company, Paul.
Okay, Xerox I know nothing about except for the fact we had to explain to Gio what a copy machine was because he doesn't need to ever use one. And instead made a funny joke and said, next we'll talk to you about fax machines.
And beepers. What is the market cap for Xerox?
All right, let me go down. Look at this big drop in Xerox.
Well, that's what Gio just mentioned. Yeah, look at that. We normally don't look at the stock at the moment, but Paul, scroll back up there because it is stock price. Alarming at the moment.
Yeah, it was almost $40 a share just a year ago, and now it's at 23, and it got as low as 15 or so.
Okay, Xerox.
$4.6 billion company.
4.6 bill.
Remember, we care about market cap and not stock price. Look at this PE, Seth. 5.6. This is one of the lowest PEs we've seen.
So I think there's one bigger than that. BTI is 1. Like literally, I think it's 1. Last time I checked, it was 1.
Oh, British Tobacco has a PE
I'm gonna go ahead
of
and
1.
say no to that one.
Pillar number, what is PE?
Okay.
Pillar number 2 is profit margin. We want this above 10.
Now
baby.
I'm gonna override this check mark, this X. It says 5% here for the last quarter, but if you look at the last year, they're over 10%. 933 in income on 7.5 billion. I'm gonna give it a check mark. Even though this is the profit margin per quarter, and I always look up sometimes without you guys seeing to make sure it's consistent. I am going to override this X and make this a check mark.
Not to stray, Paul, but this young man next to me who's 10 did his research on BTI. He's not the PE ratio for BTI is 2.6, Paul.
So what I say, it wasn't 1?
That's correct.
Okay, so I'll go ahead and take that as a
nice so you lose again, G. All right. We are moving on to revenue growth, Paul.
Guys, 11.46 down to 9 billion.
Uh-oh.
X. Now, guys, look at this. Look at their last 10 years. It has been lower every single year for the last 10 years. We're becoming more of a digital age. This is why the PE is so low. The revenue in this company is plummeting. Guys, they did less than half the revenue. Now, they sold something here. Obviously, something was sold here. And I have a hard time believing a company fell 40% in revenue in 1 year. They sold something here, but this is why the company's PE is so low. Now, that doesn't mean you ignore it. Because I told you before, I've said this 1,000 times. Let me draw this up again. Notepad.
Paul, while you're pulling that up, I'd love to congratulate you and Don and we hit 200 viewers for the first time ever, folks. We appreciate you guys being on this ride. Nate, can you turn that heater off? We appreciate you guys being on this ride with us, and hitting our first 200 viewers on a live stream is incredible, and we just can't thank you enough for your support. Paul, go ahead and pull the notepad. Let's talk.
And okay, so let me give you my example here. Even though revenue is falling, if a company was going to make $5, then $4, then $3, then $2, then $1, then go out of business, this is still, even though it's decreasing, it's still worth something. How much are you willing to pay to get this stream of income, even if it's going to go to zero?
I was hoping you were going to bring this up, Paul, because I love because I don't think about this. We see companies going down.
We're like, oh my God, this is terrible. Everything has a price, even a declining company. So here, you're going to get $15 in cash flow over the next 5 years. The question you have to ask yourself is, what do you want to pay for it? Or you want to pay $1? Of course. 2? Of course. 3? Of course. 15? No. There's some price between 1 and 15 you're willing to pay for this. So you just have to wait for it to hit that price. That's the big thing about declining companies. Don't just ignore a company because it's declining in revenue. Go look at that PE. That PE, I guarantee, is low because of that number right there, because the revenue is falling. This looks like an opportunity to find some information. Here's the interesting part. 448, 1.35. But, so it's a check mark. But look, 448, lost 471, made 195, made 361, made $1.3 billion. Something happened here. They sell something off. I mean, this is a big jump. I don't know why that is.
Folks, if you know what happened with Xerox, let us know. Paul, we did get some information about that last company we were talking about, Intel, and what they were buying. So it was a $2 billion acquisition.
And guys, I have some more bad news on Xerox.
Oh, God.
Look at this. They did $9 billion or whatever in 2019. In the last 12 months, they've only done $7.5 billion.
Oh, that's worse.
Yes. Gio's always here for his color commentary.
And they've made $933 million in the last year. So again, you need to figure out if this keeps declining, can it still make money to give you a return? That is the question you have to ask.
Should we look at number of shares outstanding, which is pillar number 5?
Number of shares outstanding here at the bottom. Luckily, it's decreasing, 266 to 222. Check mark there.
Okay, check mark for pillar number 5. Pillar number 6 is current assets greater than current liabilities.
Okay, current assets is $6.5 billion. Current liabilities is 3.3 billion.
That's good.
Yeah, they have 9.7 billion in total liabilities. So you want to understand what their assets are and make sure they can cover that if the company would go under or they have to be liquidated or something like that.
Pillar number 7, this is granddaddy of them all, free cash flow growth, Paul. We want to see the free cash flow going up, of course.
1.45 billion down to 700 million.
That's half.
That's half. That's an X. And then we had 660, and then we had negative 370, and then we had 1 billion.
The average free cash flow is 0.68, Paul.
Okay, 0.68 billion, $680 million.
Uh-oh. 680
I mean, it's
million.
currently selling for 7 times free cash flow, not even. What's 4.5 divided by 0.68?
Divided by 0.68 is 6.6, Paul.
All right, so it's currently selling for 6.6 times free cash flow, guys, which means if the company stayed the same in 6 years, if all the free cash flow stayed the same, everything stayed the same, in 6 years you get your money back. That's 17% return on your money. That's pretty solid. I would say on this company, before you go out there and put a lot of money into it, be very cautious. Understand what their plans for turnaround is. Find out if Mason's correct, that that their money is down because of, it could be a good play, but you have to see a turnaround process still, or else maybe you want it around this price or a little bit lower. It's just going to be very, very tough when their revenue keeps declining. You have to sit there and figure out where it's going to go.
You have to probably see, do you think it's going to go down? Or if it stays the same, then you're fine. But if it's going to keep going down, then you're probably
In fact, if it stays the same, you're going to make a lot of money. If it stays the same, I think you're going to make a lot of money. The question is, if it goes down, how fast does it go down? You can still make a lot of money if it goes down, but they still have $10 billion in debt they need to handle.